So part two of Shark Jumpers involves all the information from part one, but let's throw a few wrinkles in. Should they pursue the jet ski project if the following's true? So they got to pay $1 million to buy the jet skis. That's a lot of money. So they need to take out a loan, so they get $1 million, but then in a year they'd have to pay interest of $100,000. In 2 years they'd have to pay interest of $100,000 again, and they have to pay back the loan, so they have to pay back $1 million in 2 years. So is this something we need to incorporate in the analysis, and if so, how? The answer is this doesn't matter. Notice these are payments associated with debt. We ignore those because we want to separate out the decision of where we get the money to how we spend the money. And so someone might say, but wait, those are real cash flows. They're really going to get that and really have to pay that. Think about it this way. Suppose they make this loan or they agree to this loan. So they're on the hook for these cash flows. Is the jet ski project a good use of that money? So we want to separate out those two decisions. So yesterday they signed a contract with Arcola Designs to develop a new logo. So they signed the contract yesterday. And what are the terms of the contract? They're going to develop 3 potential logos: shark riding a jet ski, shark, water skiing, and, I don't know, a shark hanging out at the beach getting a suntan. And in 1 year from now, so it's right in the heart of when this project is, it would be a fixed payment of $50,000. So the question is, do we just subtract 50 from the analysis we did before? Do we need to make it as additional costs? So costs would go up by 50. And the answer is, it doesn't matter. It is a sunk cost. They signed the deal yesterday. So here we are today saying, should we do this project? And no matter what we decide, they're going to have to pay $50,000. So with minus without, if they do it, it's 50. If they don't, it's 50. 50 minus 50 is 0. So all the analysis we did in part one would be the same if this was additional information. A new one. So there's some concern that with the jet ski activity, that there's some customers who would have come and done motorboating and water skiing that instead are going to do jet skis, and that if they didn't have jet skis, they would have done water skiing. As a result, the revenues produced by the traditional motorboat and water skiing activities would be $100,000 lower by having this other option. But since there's less of this, costs would be $50,000 lower. So the question is, do we incorporate this in the analysis, and if so, how? And the answer is yes, it could potentially alter the analysis in part one, so let's take it into account. These are side effects. Remember, we want to look at with minus without, the whole firm with minus the whole firm without. So the jet skiing's doing well and, generating revenues, and, it has costs associated with it. But for the whole firm, there's a negative effect on costs and revenues because there's going to be less of the traditional motorboating and jet skiing or water skiing and motorboating activities than there would be if they didn't do the project. So the way we want to incorporate it is go directly into the income statement by seeing how it affects revenues and costs, because we'll work our way through, because it actually has an effect on taxes, so you can't just simply subtract 100 or 50 from some cash flow number or some net income number. So what would be the revenues and costs that we would need to put into our analysis? Well, for year one, remember we were told $900,000 is what they expect from jet skis, but $100,000 less to the water skiing. So as a result, the entire firm would expect to see an increase in revenue of $800,000 if they pursued the project. Likewise, in year two, the relevant effect on revenue is $1.1 million. You get $1.2 million in jet skis that you wouldn't have if you didn't do the project, but there's $100,000 less coming out of the motorboating operations that is a result of the project. But since you've got less revenues, less activity, you'd have less costs, so you'd have $300,000 in cost just from doing jet skis, but the cost associated with motorboating would go down by 50, and as a result, costs for the whole firm would go up by 250 in year one. Year 2, it's a similar analysis that gets you to 350. So now we have revenues and costs, and it's a matter of figuring out operating cash flow. So we already know depreciation is 400,000 in year 1 and 300,000 in year 2, just from taking the maker's rate and multiplying it by a million. So in year 1, it's the revenues of 800, which we talked about a moment ago, minus the cost of 250 that we talked about a moment ago, minus depreciation of 400. EBIT is 150. So the effect on EBIT is, it was 200,000 when we didn't have these side effects, but it affects taxes, and that's why you have to work it all the way through the income statement. So tax rate's 40%, so taxes paid 60,000. 150 minus 60 is 90. Add back in depreciation and you get 490. So they had $100,000 worth of revenue, $50,000 worse in costs. So that nets out as $50,000 worse, but they save 20 on taxes, and that's why the net effect when you look at operating cash flow is $30,000 worse. You got to work it through. So in year 2, you got 1.1 million, 350, and 300. Taxable income, EBIT of 450. 40% of that's 180. 450 minus 180 is 270. Add back in the 300 and you get 570. Again, it was 600 when we didn't have the side effects. The side effects wind up lowering operating cash flow by 30,000, and so that's because even though it's 50 worse when you just look at revenues and expenses, there's a benefit to lower taxes paid. Change in net working capital, the analysis is the same as part 1. Cash flow from capital spending, the analysis is the same as in part 1. Terminal value, the analysis is the same as in part 1. There is no terminal value, so it's 0 all the way across. So put it all together. Year 0, you're still paying $1,200,000, $1 million for the jet skis, $20,000 cash outflow associated with building up and increasing net working capital. Cash flow in year 1 is $480,000, $490,000, the new operating cash flow, but then there's a $10,000 negative effect from increasing your net working capital. Year 2 is the big one. You get $930,000. The $570,000 is the new operating cash flow. $30,000 from basically converting all your net working capital into cash, and $330,000 from capital spending. If you remember, we sold it for $350,000, and we spent $20,000, or we had to pay $20,000 in taxes. So we have our 3 cash flows. Very risky project with the cost of capital of 23%. And notice now the NPV is negative. We don't want to pursue this project. This is a project that, now that we have these side effects, is no longer one that is creating value, and so the firm should not pursue the project.